Time for Investing 101. Investors love high dividend paying stocks, and so do traders, which is why we talk about them on the show so much. Jim Uren, a financial planner at Phase 3 Advisory Services, is here, and you say there are some myths about dividend stocks. What's the biggest myth?
Yes. Well, thanks for having me back. Yes, the biggest myth that we see is that a lot of people assume that dividend stocks tend to outperform the market overall. And although some research has initially suggested that can be true, when further research delves into that, we find out that that's not quite accurate. You see, dividend stocks, dividend paying companies tend to be a little bit bigger than others. They have a stronger balance sheet, higher profit margins, tend to have more stable earnings. And it's really those factors that tend to drive outperformance. And so when we separate based on those factors, what we find is that companies that pay dividends don't actually tend to outperform companies that don't over the long periods of time.
But isn't a bear market the best time to invest in dividend paying stocks? Because the market is down, but investors are still taking home a dividend payment.
They are still paying a dividend. And that's another one of the myths that we see a lot, is that dividend stocks tend to outperform during a bear market. On the whole, that's somewhat true. But again, when we delve back and we dig deeper, what we find is, because, again, dividend companies tend to be higher quality, lower risk firms overall, they do tend to do a little better during a bear market. However, when we separate out those other factors that we just mentioned, those companies actually don't do any better in a bear market compared to other similar companies that are also larger, higher quality, and the lower risk that don't pay dividends. And so, all things equal, what we find is that dividend-paying companies don't actually outperform during bear markets compared to those that don't pay dividends.
All right, true or false? Dividends have tax advantages.
Well, somewhat true. So if you compare a dividend to a bond, let's say, yes, generally dividends are what are called qualified dividends. They usually get a better tax treatment. However, receiving a dividend still forces you to pay tax that holding a stock that didn't pay a dividend wouldn't force you to have to pay now. So all things equal, it's better to not receive a dividend, because once a dividend is paid, the value of the stock that paid that dividend actually declines by the same amount as that dividend. So a dollar dividend that you receive simply means your stock went down by $1. And so you're actually no richer off. And in fact, now you owe the IRS some tax money that you wouldn't have before if they had just kept that money in the company and not paid out that dividend. So all things equal, we actually prefer stocks that don't pay dividends compared to those that do when given the choice, because we then get to control when we realize those capital gains down the road.
I can say this is the first time anyone has ever said that on our show. I'm still on the fence, but that's how you make a market. Thank you, Jim.
Thank you. It's good to be here.
Go to businessfirstam.com for where to see our show on TV.